How you doing? All right. Going to talk about income protection and a couple of the details about it, which not everybody's kind of aware of. Because I'll get emails asking about income protection, and people want to go, how much is that going to cost? Okay, there's a couple of variables with income protection. First and foremost, depends how long you want it for. So usual scenarios up to retirement age, so whether you're retiring kind of 60, 65, 68, product will take you up to retirement. It'll pay you an income up to retirement. Generally there's a deferred period, and that can vary from 4 weeks up until a year. It's obviously going to be more expensive 4 weeks, and it'll be less expensive if you have a year deferred period. What that means is it won't pay out anything for the first the deferred period. So if it's 4 weeks, it won't pay out for 4 weeks, and then it'll pay out. If it's a year, it won't pay out till a year. Now, rule of thumb with what you should have, and most people don't have this. I'm not going to talk about myself, but normally you should have put by about 3 months worth of income. You lose a job, something happens, you should have about 3 months. So 3 months is 13 weeks. So there's where your 13-week deferred period comes from. So that's kind of the usual stance on that. So 13 weeks deferred period, and then your income protection kicks in. Obviously, how the level of activity will affect the premium. So if you're at a desk job and you're in an office and stuff, and there's little or no risk on anything happening to you, then the premium will be cheaper. And obviously, if you're really active and you're doing something that involves risk or machinery or various different things that will increase your risk, even like there's so it'll a scale of 1 to 4. So office worker being a 1, and someone who's working with machinery probably a 4. In certain instances, certain occupations are declined, obviously for the reason that they're too much of risk, like motorcycle couriers and various things won't get income protection because of the chances of something happening are very high. There's 4 companies that do that at the moment, as far as I know. New Ireland, Friends First, Irish Life, and Royal London. Is it Royal London? I'm not too sure about Zurich, but it's 4 anyway that I know that are doing that, and they're various different premiums, and each of them is different in their own way. There's a couple of lesser products. I think Friends First have a lesser product, which is a 2-year to pay your income for 2 years, which is called a wage protector. I'm not too sure if any of the other companies are doing that. And then you have a bottom of the market. It's not really an income protection product, it's a rider benefit on a life assurance. It's called accident benefit, and that pays out max 400. So Zurich and Irish Life pay out 400, and New Ireland pay out 300. So that's a max they'll pay out on that. And that's like an economic solution to if you haven't got the money there to pay a full income protection product, that'll kind of get you out of a hole, I suppose. Now with them lesser products, they basically cover you for 52 weeks, and when the 52 weeks has been used up, that aspect of the policy is gone. With the proper income protection, or the income protection products, they basically kick in and they pay out right up until retirement. There's a couple of little details in relation to indexing and various different things, and if you want to DM me, I can go through them with you. But by and large, it's a good thing to have, and especially if you're the owner of a company and the company can pay the premiums for you, it's a very good use of the money in the company. All right, take care and talk to you soon. Bye.